Welcome to Matchback Systems podcast. I'm delighted to introduce our guest today, Matt Muenster. Matt is Senior Manager Applied Knowledge at Breakthrough, one of our supply chain neighbours in Green Bay. Matt is an expert on international fuel markets, specialising in maritime shipping. So with the implementation of IMO 2020, we couldn't ask for a better qualified person to give us some insights on the subject. So welcome and thanks very much for joining us, Matt.
Thank you for having me, Heather, and hopefully I can live up to that kind introduction you just gave.
I'm sure you will. So let's start with an overview of Breakthrough. Can you tell us a little about the services that you offer and then your role in particular?
Absolutely. Breakthrough is a fuel and transportation solutions company. We're experts in managing the energy and information in the global movement of goods and consider some of the largest retailers, consumer packaged goods companies, food and beverage companies, and other durable manufacturers to be our clients. And so we manage the cost, consumption, and emissions in helping shippers move their goods to market and have really patented technology, dense market knowledge, and data that allow us to create these models to perform these calculations and help shippers accomplish those goals. Personally, I'm a senior manager of applied knowledge, and it's part of my responsibility to be a trusted market advisor to these clients across energy, really the transportation energy industry. And my day-to-day work consists largely of forecasting fuel prices and assessing market risks. And so therein lies the peak interest in an event like the International Maritime Organization's 2020 Sulfur cap, because it is a risk that's being discussed and has been for many years, but it's kind of unique in this space because it's a risk that across transportation supply chain professionals gets elevated into their C-suite, which doesn't always happen in transportation energy market developments. And so Breakthrough has fuel management services across several modes of freight transportation. We began in truckload fuel management in 2004, had moved on by the request of existing clients into intermodal freight and ocean freight, which has become a growing part of our business really over the last 5 years. And collectively in 2019, we'll be managing fuel on over 16 million shipments across these modes of transportation.
Wow, so that's great. So you need to analyze a lot of data, and the fuel market is a complex one. How important is technology in your work, Matt?
Technology really drives Breakthrough's business. It's the core of our business, and in being able to use models and dense data to calculate the cost, consumption, emissions of moving goods, but then again using technology to then capture the history of all these calculations and build a really robust database to then further develop models from. I'm working with our core technologies and am immersing myself into both our internal database as well as external energy market data on a daily basis.
Okay. And are there any sort of tech trends or innovations in the industry that could help you or that have caught your attention or that you see on the horizon?
Yes, absolutely. In regards to the maritime industry, we see IMO 2020 has been a catalyst for change, particularly in fuel efficiency and alternative fuel development. And it's really just a beginning point for the industry. There's already goals to reduce greenhouse gas emissions by 2050. There are likely to be stepping stones pushed out by the International Maritime Organization along the way. And so because of this, we're already seeing advancements in power and propulsion systems, in the hull and superstructure of vessels. Some unique sails are being created to harness energy, cylindrical sails on tankers and other accommodating vessels. And beyond the fuel efficiency and alternative fuel space. We're also seeing really significant development in steps being made toward the enhancement of service. And namely, in 2019, we've seen a lot of talk about blockchain developments, partnerships between such massive companies as IBM and Maersk and other prominent carriers now joining that particular platform. And so there's a lot of motivation in an industry where transparency has been desperately needed. And so these are some of the trends that we really see on the horizon, is that this push toward cleaner fuel, more efficient fuel is going to be continuous, and that there is still a desperate need for transparency in the industry, and maybe blockchain will ultimately fulfill that role and improve service between shippers and their carrier partners.
Right. Interesting. So let's talk about IMO 2020. So the regulation is coming to effect now, whereby the sulfur content of marine fuel must be reduced from 3.5% to 0.5%. So how are ocean carriers complying with this mandate? How many are switching to low sulfur fuel? How many have installed scrubbers? What's your take, Matt?
So our perspective at Breakthrough, having tracked this especially close since we could really see it being finalized in 2016, is that the overwhelming majority of the market will move toward low sulfur fuels, although we've seen an uptick in the number of carriers that will use the exhaust gas cleaning systems or the scrubber devices on their vessels. And so just to provide some context, in recent months, we've already been seeing this transition, of course, especially since the beginning of the fourth quarter. And so at the port of Singapore, the world's largest bunkering hub, somewhere along the lines of 16 to 20% of world bunkering and fuel consumption in the maritime industry occurs there. But we've already seen the pattern in movement toward low sulfur fuel, and very low sulfur fuel oil, the new 0.5% spec fuel, will certainly be the winner in the market. I think a year ago there was concerns that marine gas oil, the low sulfur fuel that's presently being consumed in emission control areas internationally, might be a fuel of choice because trust wouldn't be high enough in the new spec very low sulfur fuel oil. But very low sulfur fuel oil among the low sulfur slate will have dramatic command of market share. We'll also expect to see just a few thousand vessels with scrubbers installed at the time of the compliance kickoff on January 1st. Most estimates are between 2,000 and 3,000. And among those vessels, the largest and those vessels that consume the most fuel are kind of the low-hanging fruit, where the economics work out the fastest for the carriers and the owners of those vessels to receive payback on what is a pretty hefty capital investment. And so very low sulfur fuel oil and scrubbing equipment will really be the conventional practices moving forward. Of course, vessels will need to continue to consume the low sulfur marine gas oils within emission control areas closer to international ports and in those coastlines where that applies.
Okay. Actually, it just occurred to me, do we know what happens if they don't comply?
So that's been a question that's lingered. Compliance and enforcement, or I should say enforcement, will really vary by port. We expect the most significant bunkering hubs, those dozen to 15 or so that make up about 2/3 of global consumption, will have hefty enforcement standards, whether it's through hefty fine. In some instances, at the Port of Singapore, and I believe the Port of Hong Kong, imprisonment for the operating captain as well as the vessel owner has been discussed. And so it really comes down to the ports to pursue effective enforcement. and we think that there'll be mixed results in that enforcement, although it certainly is of utmost interest to the blue chip carriers of the world to be in compliance, because of anything to ensure enforcement, perhaps negative public relations and adverse reaction by shareholders might be one of the more adverse effects that come out of IMO 2020 should a carrier be found non-compliant. And so just for the sake of not being caught in the act of cheating, there's a pretty good acceptance across major carriers that there should be a high level of compliance in the marketplace. Okay,
interesting. So it's been estimated that compliance will cost carriers around, I don't know, 10, 11, up to $15 billion. I know there's a lot of variables to consider, but one thing's for sure, it's going to cost shippers more to ship their freight. So here's the big question, Matt. How much of the cost of compliance are carriers passing on to shippers through new BAF charges?
Our perspective at Breakthrough and what we've experienced at conferences in the industry, as well in trade media coverage of IMO 2020, is that carriers have really thrown out their old conventions of fuel cost recovery. That the past surcharges that they had through really the first half of 2018, before a wave of changes to their bunker adjustment factors, those old programs have been thrown out. They've been replaced with new models really across every major carrier that carriers hope will be more successful in recovering their fuel costs of carrying shippers' goods to market. And so it's our perspective that that carriers really intend to pass on the whole fuel costs onto their shipper partners. What we also know, though, in the data that we're seeing, the estimates shared by carriers to shippers and fuel amounts that are shared in bids, is that it's not true that the full amount's being passed on in all cases, that just like the freight rates are leveraged in this way, fuel amounts post the IMO 2020 compliance date of January 1st are also going to be used to capture market share. And so fuel amounts shared by carriers are going to be used competitively. There's likely to be instances in which carriers drop their fuel amounts to secure more business with shippers and to capture a greater amount of market share. And so while there's significant risks to carriers not recovering this intense increase in fuel costs, we still think that some of the historic dynamics of the industry are going to linger.
Okay. What's your opinion on the changes we can expect in the marine fuel market as a result of IMO 2020? You know, is it going to be a bumpy ride or smooth sailing? So first off, how are the refiners and fuel suppliers adjusting? Will there be enough supply of low sulfur fuel to meet demand?
Yeah, so great question. When talking about the various risks and whether IMO 2020 might be a bumpy ride or smooth sailing, we've kind of pinpointed three particular issues that have arisen in the industry when discussing bumps that might arise. And it kind of comes down to availability, compatibility, and stability of the new very low sulfur fuel oil on the market. In terms of availability, in recent quarters, this has seemed like less of the challenge. That we think the refinery base is well prepared to provide very low sulfur fuel to the market, and in fact, they're economically incentivized and motivated to do so. And we've also seen price discovery for the new fuel at something like 100 ports internationally. And so the availability of the fuel, from our perspective, is less of a question. We think the other top subjects of interest being the compatibility of very low sulfur fuel, meaning how well one supplier's very low sulfur fuel mixes with a second supplier's very low sulfur fuel, and its respective fuel specifications remains in question. That there hasn't been a tremendous amount of time since very low sulfur fuel oil availability really ramped up in the marketplace for carriers to do any sort of excessive testing of the various blends across the suppliers. And so one way to mitigate this risk, we've seen more contracting between carriers securing that very low sulfur fuel oil in their predominant ports. And then the stability question, we think, has also been largely answered, or basically the cold flow properties of fuel. Is there concerns for the very low sulfur fuel oil that its properties might gel, for instance? And so out of those three top concerns, maybe compatibility lingers as a concern in the marketplace, especially because the fuel spec can vary across suppliers. We know that it does. There's actually some price difference in very low sulfur fuel oil across major geographies because that spec is different and the fuel is being created differently. In example, we know that European suppliers and refiners are consuming a lower sulfur crude slate because their refining equipment isn't largely consisting of the coking units that can really destroy and take sulfur out of the fuel, so they need a lower sulfur crude oil to begin the refining process from. And so for that reason, this compatibility issue is probably going to linger in the market for a couple quarters.
Okay. So how much, that leads me to think, how much price volatility do you anticipate? How long will it take for the fuel market to rebalance?
When concerning price, we've already seen a fair amount of price volatility, although not from every marine fuel. Marine gas oil and the very low sulfur fuel oil have been far less volatile in the fourth quarter of 2019 than has the high sulfur fuel oil. And this is an expectation because demand is drastically shifting from high sulfur fuel oil. And so really following a spike in its price due to the attacks on Saudi Arabian oil infrastructure in late September, we've seen its discount to crude oil grow dramatically. It was trading at closer to $500 a metric ton. High sulfur fuel oil is now below $300 per metric ton. And we think that would be a challenging number for it to surpass in the near term, that more of its demand is shifting away, more demand in the maritime industry, I should say, is shifting away from high sulfur fuel oil. It's going to have to kind of refine its own market demand, perhaps in other segments like power generation, for its price to buoy back up to the levels that it had. Meanwhile, gas oil prices have remained well below their high price points experienced in 2018. It's our expectation that the low sulfur gas oil, as well as the new spec fuel, very low sulfur fuel oil, will experience some price pressure in their particular fuel premiums as demand continues to shift. Now that we're into December, we're getting closer, of course, to that new market reality, that new market demand share for these respective fuels. But just because the compliance date is reached in January 1st, we might not be through price volatility. At Breakthrough, we're really eyeballing this spring, in particular, the refinery maintenance and turnaround season that typically occurs anywhere from, say, late February into the beginning of May, as a potential period for still lingering price premiums on low sulfur fuel. And that's because during those times, due to maintenance and turnarounds. Refining utilization dips, which is to say refiners are supplying less of these transportation fuels into the market. And so if demand remains very, very high, and these are new fuels, and this new shift probably will keep it that way, that there can be strains on the supplies of these fuels. On the flip side, kind of one reason why we might not see dramatic price spikes, as was feared a year ago, is that we're seemingly in a comfortably well-supplied oil market. That the Saudi Arabian attacks helped to show that. It was perhaps the most significant attack on oil infrastructure, or was, in decades, and still prices didn't spike. They really surged for a day or two and then kind of normalized. And so because crude oil continues to account for 50 or over 50% of many transportation fuels price buildups, as long as that price of crude oil is stable in where we've been with West Texas Intermediate in the $55 to $60 per barrel range, that really limits the prospects of a price spike.
Okay. Now, switching gears a little bit, there's been speculation about how the switch to low sulfur fuel oil for vessels could affect over-the-road transportation. So how do you see the potential impact on diesel supply and the price at the pump for truckers?
Yeah, this is a great question, and it's been a question that's come from clients, especially in the domestic North American trucking market, one super diesel dependent, over the last couple of years. And like I kind of mentioned in discussing marine fuels, a year ago, there were some concerns, particularly when we reached the 2018 high price points for diesel during the month of October, that IMO 2020 could really have some profound impacts on diesel prices. What's changed since then is we have better understanding of the way that the very low sulfur fuel oil is being blended, that there's less of a dependence on other low sulfur distillate fuels like an ultra low sulfur diesel consumed in the United States, as well as its blend stocks to need to make those very low sulfur fuel oil blends. And so some of the price pressure has come off as we've gathered more information regarding how the new fuel is made. But additionally, the oil market, as I mentioned, we've seen inventory builds as of late, and we know that it's reasonably well supplied. And also, when speaking to just diesel as a commodity, its price premium, or the premium paid for a barrel of diesel fuel over a barrel of crude oil that it's refined from, has remained far below what it was in 2018, and much of that's due to macroeconomics and the macroeconomic outlook. That 2018 was an intense year in truckload markets. It's a year when freight costs for trucking was making its way into C-suite conversations, because there's some pretty intense pressure there as we were experiencing solid economic growth. In 2019, of course, that's stepped back. Growth hasn't been as significant. It's remained healthy in the United States, much less so in other economies. And so there isn't that kind of intense pressure on diesel premiums that there was a year ago either. And so when considering these few factors, we've really stepped back and had conversations with clients that we don't see IMO 2020 offering anything close to a price spike on the diesel prices, perhaps some elevated pricing through the first quarter, but ultimately other factors like geopolitical risk will factor much more prominently into potentially higher prices moving forward.
Well, that's good news, Matt. Great.
Yeah.
Let's finish up by looking to the future. So there's pressure building over environmental issues, and there are some ambitious targets to reduce emissions. I mean, you mentioned IMO, with their target of reducing emissions by 50% by 2050. So what shifts do you foresee in the fuel market in the coming years?
This is the kind of question where maybe it is only the more appropriate that IMO 2020 kicks off the first day of a new decade, because it can really begin what is shaping up to be some transitioning dynamics across refined products. That we know the maritime industry, which is internationally regulated and is unique in that sense, already has its eyes on greenhouse gas emissions and emission targets. Other modes of freight transportation aren't there yet, and when they are, it can potentially be a lot more fragmented. But we know that will likely need to change, that conventional fuels need to be cleaner. The fuel portfolio is growing. There are existing opportunities across modes of freight transportation to leverage cleaner fuels and reduce emissions in supply chain. Corporate social responsibility and sustainability goals are forcing the transportation industry in that general direction. And so there's a shakeup that's occurring here. And I think one of the unique data points that we offer and discuss this further with clients is that the maritime industry is discussing greenhouse gas emissions, but in terms of a freight ton mile or freight time kilometer leveling statistic, per freight ton mile or kilometer, the maritime industry is far and away the most efficient mode of transportation in terms of moving freight and in terms of the greenhouse gases that are being created. The truckload industry, on the other hand, is far, far dirtier, which certainly makes sense when it comes to greenhouse gases per freight ton mile or freight ton kilometer, however you'd like to level set. And in the United States, one of the other interesting developments is that just in 2016 or 2017, the transportation sector surpassed the power generation sector as being the sector that creates the most greenhouse gas emissions annually. And so there's enough data pointing in the direction that policy for emissions content in freight transportation needs to change. And so as I began the answer to this question, maybe only the more appropriate that we have this sulfur mandate to kick off the decade, and one that promises to continue momentum toward cleaner fuel and more intense emissions policies and practices.
That's great, Matt. Okay, so one quick question. So in terms of alternative fuels, how do you feel about sustainable fuels going forward, a switch to biofuels and LNG, for example?
There's lots of development in this space in the maritime industry. LNG is certainly gaining traction to the point where many of the power units coming out are dual fuel capable. They're capable of consuming the gas oils and low sulfur fuel oils, but will also be are hybrids in a sense and can transition to liquefied natural gas. And so LNG really has a presence in the maritime industry, especially as a bridge fuel to lower greenhouse gas emissions in the interim. But in its own, it's unlikely to be able to hit the longer term target that the IMO has set for 2050. And so there's got to be other viable alternatives. You mentioned biofuels. We've already seen carbon neutral shipments actually this year moved by the liner industry and getting goods to market. And so they're able to use biofuels to have a carbon neutral shipment on vessels to date. But as far as the broader wide scale economics of those moves, they don't quite work out yet. It's not nearly cost competitive with the other conventionals in the market. Important though, one talking point to come back to, and we do this across modes of freight transportation because obviously electricity in the heavy duty truck market renewable natural gas, renewable diesel, biodiesel. These are all being discussed as plausible alternatives in the market. But, you shouldn't just leave the conversation at alternative fuels. I think exhaust gas cleaning solutions in the maritime industry show that technology has a role to play in reducing fuel consumption and emissions from supply chains. And so the best policies are going to be those that are inclusive, that certainly we hope momentum continues for alternatives, but also for the kind of innovations that help reduce emissions in the supply chain. And at Breakthrough, that's our keen interest in helping shippers find those competitive advantages.
Cool. Same with us, Matt, at Matchback Systems. Okay. So it's been so interesting talking with you, Matt. I could go on for hours about this subject. Thanks very much for sharing your expertise with us. It's been fascinating. Thank you so much.
And thank you for having me, Heather. I've really enjoyed our conversation.
Okay, cool. Thank you.